Thank you so much, David. We are really thrilled to be here tonight. Politics and Prose is, as you know, an iconic institution in Washington, and it's just a thrill to be here with you, and engaged customers. Wow, that's really fantastic, and it's wonderful to meet David and to see in person this incredible institution that everyone loves so much in Washington. Now, Josh and I have been a little bit on the book tour. The book came out May 24th, and among the questions that we always get, or often get, from interviewers, buyers of the book, email in my email account at the Times, what surprised you the most about your reporting and the investigation that you both did to come out with this book? We all know that there have been a lot of books about the financial crisis. Many of them recount the events during the crisis in the heat of the panic of 2008. Some of them go back a little bit further in time to describe some of the groundwork that was laid to create the crisis. But Josh and I decided to go back much farther into the early 90s to really tell the tale, because a debacle this large really didn't happen overnight. And unlike some of the book's conclusions, other books' conclusions that it was nobody's fault, sort of a concatenation of events that could not be helped, we really believe that there were actual parties involved laying the groundwork. But as far as what has been most surprising to me in this exercise is the number of paradoxes that emerge from this story. The paradox of powerful participants in the events leading up to the crisis who continue to this day to be in positions of power, or are even in positions of greater power than they were. A second paradox, that trillions of dollars of losses being endured by investors and borrowers, yet no one involved in the mess being held accountable. But to me, the most perplexing paradox of all is this: how did it happen that the drive to expand the rate of home ownership to first-time home buyers, many of them minorities, immigrants, and other lower-income individuals, how did it happen that this partnership, this push, wound up trapping them in loans that they could not afford and putting them squarely on the road to financial ruin? In other words, how did the dream of home ownership become such a nightmare for so many first-time home buyers? It's really an awful paradox when you think about it. Government officials, in the belief that homeownership was a win-win for everyone, opened the door to predatory lenders who lured the least sophisticated people into the most poisonous loans. These included loans with prepayment penalties of high interest, prepayment penalties or high interest rates. A report by the Center for Responsible Lending looked at 1.8 million loans in the early 2000s. It showed that from 2000 to 2004, borrowers in minority neighborhoods received a disproportionate number of loans with prepayment penalties. The center found that borrowers living in zip code areas where more than half of residents represented minority groups, the odds of receiving prepayment penalties were 35% higher than those of similarly situated borrowers in zip codes where minorities comprised less than 10% of residents. The study controlled, importantly, for key borrower, property, and loan characteristics, such as borrower credit scores, to ensure that the results were not, repeat, not, based on differences in risk factors. Now we move on to the apex of the boom, and the center made another study of 177,000 loans in 2006. And it concluded that the odds of receiving a higher rate, fixed rate purchase loan were 71% greater for African Americans than for whites. African Americans in the sample were 15% more likely to receive a higher rate adjustable rate mortgage than if they had been white. And African American borrowers were 44% more likely to receive a higher rate on their fixed rate refinance loan than for a similarly situated white borrower. Latino borrowers were similar. Receiving a higher rate fixed rate purchase loans, they were 60% greater than a similarly situated white borrower. These data support what I found in my reporting about Countrywide Financial, one of the biggest subprime lenders before it was acquired in a fire sale by Bank of America in 2008. According to a former broker who spoke to me from the Los Angeles area where he worked for Countrywide, it targeted low-income borrowers with high-cost loans. Instead of receiving the best loan possible, as Countrywide's advertisements promised, borrowers were led to high-cost loans that resulted in rich commissions for Countrywide's smooth-talking salesmen. These loans also contained outsized fees to the company's affiliates, providing loan services such as appraisals and insurance, and also carried punitive prepayment penalties or interest rates that were set alluringly low at first, only to skyrocket in a few years' time. Countrywide Financial's founder, Angelo Mozillo, talked enthusiastically of wanting to help minorities and low-income Americans secure a mortgage. Doing its part to democratize the home loan business, Countrywide became the #1 lender to both Hispanics and African Americans. In a February 2003 speech here in Washington, Mozillo promised to devote $600 billion to mortgage loans for underserved communities through 2010. And yet, according to company insiders, Countrywide's systems were designed to increase costs for precisely these types of borrowers. One former mortgage broker in Los Angeles said that Countrywide branches in upscale neighborhoods like Beverly Hills or Santa Monica had to slash their mortgage rates to be competitive with rival banks. But in areas that were predominantly minority, Countrywide's rates were far higher because company executives knew borrowers in these neighborhoods had few, if any, alternatives. The former employee told me, "I'll put it this way. At Countrywide's Santa Monica branch, they lost anywhere from 1 to 2 percentage points on a loan. If they broke even, they were lucky. But in black areas, like the Slauson branch, the average points charged per loan was anywhere from 2 to 4 percentage points. And you were reprimanded if you did not charge more." Countrywide's entire operation, from its information technology to its incentive pay, was designed to wring maximum profits out of the mortgage lending boom, no matter what it cost borrowers. The company's computer system, for example, defaulted to a setting that automatically excluded a borrower's cash reserves from his or her financial statements. This had the effect of making the borrower appear to be less financially sound, and he or she would be steered away from lower-cost loans into those that were more expensive and more profitable. Now, Countrywide, of course, was not the only lender that appears to have targeted minority borrowers. A recent lawsuit against Wells Fargo over loans that it made in Tennessee found that its foreclosure rates in black neighborhoods of Memphis are almost 18%, 5 times the rate in predominantly white city neighborhoods, and 7 times the rate in predominantly white county neighborhoods. According to a sworn statement by a former Wells Fargo credit officer named Mario Taylor, cited in this lawsuit, quote, "The prevailing attitude was that African American customers weren't savvy enough to know they were getting a bad loan, so we would have a better chance of convincing them to apply for a high-cost loan." Of course, high-cost loans make it that much harder to build up equity in your home, which has been the biggest source of wealth for many people over the years. And these punishing loans obviously increase the odds of foreclosure. a study by the Atlanta Constitution of foreclosures in that